Hi, everybody. This is Alan Ellman, the Blue Collar Investor, with this BCI podcast number 41 titled Collar Trades When Call Strikes Move Deep in the Money. We're going to use a real life example with Atlassian Corp., which trades on the NASDAQ exchange under the ticker symbol TEAM. Now, covered call writers, sometimes when they add a protective put, there's a little confusion as to how to manage the trade and how to do the calculations. So with this podcast, we're going to focus in on a real life trade made with Team, and we're going to show you the various legs of the trade, the calculations, and then we're going to just mention some of the exit strategies and how to focus in on trade management once the initial trade is set up. Let's first define what a collar trade involves. Well, in essence, it's a covered call trade, but we just add in a protective put. We're taking downside insurance protection in case the price of the stock drops exponentially. So we have three legs of the trade. We long the stock, we buy the stock just as we would in a traditional covered call trade. We sell the call option. There's your covered call trade. We're long the stock, we're short the call option. The addition with the collar is we're buying a protective put. Now, generally speaking, the call option is out of the money or higher than the current market value of the stock. And the put option is also out of the money, which is lower than the current market value of the stock. So those are the typical ways that a collar trade is structured. Now, let's talk about a real life example with TEAM, which was purchased on July 30th for a price of $71.32. So if we go with the traditional collar, we're going to sell a call option at a higher price, and we're going to buy a put option at a lower price. So on 7/30, the August 17th, 75 out of the money call was sold for 80 cents. So remember, we're starting the trade on July 30th, and expiration is on the 17th of August. So it's about an 18, 19-day trade. Now, at the same time that the covered call trade was entered, we also bought a protective put at a $65 strike price, also expiring on August 17th. So there are the three legs of the trade. We're long the stock, we're short the call option, and we're long the protective put. Now, what happened was, by August 9th, Team had accelerated in price to 78.23, leaving the 75 call option strike fairly deep in the money, with only 8 days left until expiration. So if we fed this information into the BCI Collar Calculator, we would see the following results. Since Team is trading higher than the 75 strike, we would look for the row that says return if the price is greater than the call strike. In this case, the calculator shows a return, an 18-day return of 5.58%. That's taking into consideration the call premium plus share appreciation from 71.32 up to the 75 strike. Now, since this is an 18-day trade, by expiration, this would annualize out to 113.16%. So that's the way the trade was structured. And at that point in time, with Team trading well over 75, the maximum return seems to have been realized. Of course, we still have 8 days left. Now, what about management possibilities in this particular situation with the call strike fairly deep in the money? Well, when we do a collar trade, we have to still look at it like it's a covered call trade. And with covered call trades, the main leg of the trade that's managed is the short call. So if the price of the stock had dropped, which it didn't, but had it, we would first consider hitting a double, where we buy back the short call and look to resell it if it meets the 20% or 10% guidelines. If the price of the stock is dropping later in the contract, we would consider rolling down to generate additional time value premium. All the while, the put strike is still in place to protect us against a gap down below the put strike. So that's always in place. That insurance policy is there. But in the meantime, we could manage the short call to generate additional time value premium. Why not? Now, in this particular case, the price of the stock went up dramatically. And the strategy we would think about would be the mid-contract unwind exit strategy, which we would use if the time value component of the cost to close approaches zero and we have an opportunity to generate at least 1% more than the time value cost to close. And for that, we would use the Unwind Now tab of the elite version of the Elman calculator. Now, as we approach expiration Friday, then we always have our rolling options if the short call strike is in the money. And so we use the What Now tab of the Elman calculator to make our decisions as to whether or not rolling the option meets our time value return goal range goals, and also to make sure that the underlying security still meets our system criteria. So my main point here is that even though it's a collar trade as opposed to a traditional covered call trade, management involves the short call leg most of the time. So let's just summarize now. Collar trades should be viewed as covered call writing trades with an insurance policy, the protective put. So just because we added that put doesn't mean that we can't manage the heck out of our short call to make sure that we're mitigating losses or turning losses into gains or enhancing the gains that we already made. Now, trade management should be executed using our covered call writing exit strategy arsenals. It's all laid out in our books and DVDs and articles and videos. Very, very important aspect of option selling. It's the third required skill. You have stock selection, option selection, and of course, position management. Now, initial trade calculations take into consideration the debit caused when we buy the protective put. So for traditional covered call writing, it's just the call option that represents the credit, but with the collar strategy, we have to deduct the premium we paid for the put option, and that will give us our calculations. And the BCI Collar Calculator will do all that heavy lifting for us regarding the calculations. Now, when the share price remains the same or rises, we have a successful trade. We have to understand that when we do a collar, we're willing to accept a lower return because we have the put debit in return for that insurance policy. But if the price of the stock remains the same or goes up, based on our initial structuring, we have a successful trade. And then we might even make it more successful or mitigate losses by instituting the arsenal of exit strategies that I alluded to earlier in this podcast. Okay, so I just want to remind everybody that we have a lot of free resources on our website, www.thebluecollarinvestor.com. That includes calculators, files, training videos, beginner's corner tutorials on both covered call writing and put selling. We have a free newsletter which you can access from our blog link, and much more. We also have in our Blue Collar store online video tutorials, online streaming DVD programs with downloadable workbooks, ebooks, soft and hardcover educational books, calculators, spreadsheets, trade planners, online mentoring, and so much more, which will enhance the level of our knowledge to make sure we can achieve the highest possible degrees of success. Ladies and gentlemen, I want to thank you for taking the time to listen and or watch this podcast, BCI podcast number 41, Collar Trades When Call Strikes Move Deep in the Money. And we used a real-life example with Atlassian Corp, TEAM. Folks, I hope you enjoyed this podcast, And most importantly, hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.